According to a Gallup survey, nearly half of Americans have $0 invested in the stock market. Yet historically, investing outperforms cash savings by a wide margin. For example, an analysis by J.P. Morgan found that since 1929, the S&P 500 has delivered average annual returns around 10%, even including crashes, but many people let fear and excuses stop them from investing. Today, let's explore common excuses people use to avoid investing, so you can start building wealth for your future. Excuse number 1. Investing is too complicated. It's true that investing may seem complicated at first glance, but with some basic reading or help from a financial advisor, anyone can grasp the fundamentals. You don't need to be a Wall Street expert crunching algorithms and advanced math. Simple index funds provide instant diversification with a single purchase. It doesn't get much easier than that. Don't let Wall Street jargon deter you. Start with education. Read some beginner books, listen to investing podcasts, or take an online course. I recommend checking out books like The Intelligent Investor by Benjamin Graham and Rich Dad Poor Dad by Robert Kiyosaki. And listen to podcasts like The Ramsey Show, where they break down investing topics into understandable bits. Also, take a reputable online investing course like those offered by Udemy or Coursera to learn basic terminology of investing. Turn on easy-to-understand podcasts and videos while cleaning your house, walking your dog, or even when you're commuting to work. They'll seep in through repetition. Knowledge is power. Learn and conquer your excuses. Excuse number 2. I'll wait until I have more money. The old proverb says the best time to plant a tree was 20 years ago, but the second best time is today. Even small, consistent investments can grow substantially over decades. According to NerdWallet analysis, investing just $100 per month in the S&P 500 historically would have grown to over $200,000 in 30 years. You don't need huge sums to start. Small amounts compound into something bigger over time, like a snowball rolling downhill, whereas waiting means losing years of potential growth and dividends. Everyone wants a money tree in their backyard, don't you? But since that's not realistic, planting financial seeds consistently over time is the next best thing. Don't wait. Get started now, and let time work its magic. Every little bit invested consistently counts. Excuse number 3. The market is too volatile. It's true that markets swing up and down wildly in the short term, but historically, holding diversified investments for 10, 20 or more years smooths out volatility. Despite crashes, the S&P 500 has still averaged about 10% annual returns over decades, according to investment firm Vanguard. With a long-term horizon, commit to staying invested through market cycles. And down markets actually present opportunities. You can buy more shares at lower prices. So don't panic when you see red days or crashing headlines. These will pass if you stay disciplined. Excuse number 4. I'll wait for the perfect time to invest. Trying to time the markets based on news or charts is futile. There's no crystal ball to predict movements. Even professionals routinely fail to time things correctly. For example, many waited for the perfect pre-pandemic entry point, only to then miss huge gains when markets rebounded. Except that investing always involves some unknowns and risk. Investing is always a bit like playing the slots. You never know when you'll hit the jackpot, but keeping money consistently invested gives more chances to win over decades. Build long-term habits focused on time in the market, not chasing perfect timing. Be strategically passive. Let compound interest work its magic by staying invested over long periods. Excuse number 5. I'm afraid of losing money. It's true all investments carry some risk, but diversification minimizes exposure to any one stock or asset type. Index funds provide instant diversification, and historically, long-term returns outweigh short-term declines. Start small if needed, but don't let fear of volatility paralyze you. Avoiding investing means guaranteed erosion of cash savings from inflation over time. Therefore, with education and reasonable expectations, volatility becomes less frightening. Remember, you only lose money if you panic sell at the wrong time. So resist the urge and stay the course in down markets. The longer you delay investing, the more potential growth you miss. Don't let excuses hold you back. Start now, even small, and build knowledge and habits. You can overcome the myths and silly excuses that stop many from growing their money. Your future self will thank you. If you found this video helpful, please like and subscribe for more investing tips. Thanks for watching.